Hi, folks. This is Mike Zlatnik, Big Mike, and today we're going to talk about value add investing in real estate. Before we dive into the value add investing, I just wanted to differentiate the terms. There are terms such as value investing and there are terms such as value add investing. They're slightly different, but the concept is pretty similar from the point of view that you're investing into something that's far more valuable upon some events, either time or improvements or enhancements. So you're basically paying a price for something that is worth more. In traditional stock market investing, Warren Buffett is one of the greatest value-added investors of all times. He would be looking for a greater value. He calls it a great company. You pay a fair price for a great company. The same applies in real estate. If you find an asset at a great location at a fair price, it can be a great value investing. Over time, the location itself will take care of the business and the property will appreciate to a great extent. So value investing is simply looking for sort of a diamond in the rough. Sometimes you have to do something with a diamond. You have to make it look shiny. That's the value add component. But the value investing itself is just looking for something that's worth way more than what you pay for it. You get a great value for the price you pay in essence. In real estate, value add investing adds another element. So you could buy an asset that is in a great location that is basically appreciating over time. There is what is known as a rent inflation. Basically, rents are increasing over time. And you could also improve the property. So let's use a classic example of a value add strategy so you can get a better understanding of how it works in real estate. So value add investing in real estate, typically in real estate, when a property is bought, at least commercial property, it is bought based on its current net operating income. So its current net operating income will dictate the price depending on what similar assets trade at. So if it's a multifamily asset and it trades at what is known as a capitalization rate or a cap rate of 6%, the property makes $6 million a year, 6% cap rate, its price is $100 million. Now imagine that the rents on this property are low. The property hasn't been renovated in 10 to 15 years. The kitchens are old, the appliances are old, the carpets are old. These apartments look old, but they are occupied. The rents are low in these apartments because they've not been improved in many years. So an example would be a property like that. The rents could be $1,000 a month per door on average today. But the similar renovated property rents are much higher, like $1,400 a door. So the opportunity is tremendous. You could basically buy a property, renovate apartments internally, and as well as the property, common areas, clubhouse, siding, the roof, landscaping could all be improved. And these apartments could generate much higher rents. And internal renovations could be substantial, could be opening floor plans, replacing carpets with hardwood flooring, changing the bathrooms with brand new modern tiles, modern medicine cabinet, modern shower. In addition to that, kitchens could be replaced, great countertops, wonderful cabinets, new stainless steel appliances, and so on and so forth. The property would have a brand new feel and look, but the rents are still below the market. As the apartments are renovated, the rents could be increased substantially. So the value add work pushes the rents regardless of what market does with the rents, because the market already supports higher rent. So the value add work is simply the work of the operator of the property or the sponsor that works the property with their teams, does the renovations, buys all the materials, hires all the labor, and executes the value add. And that enhances the property substantially. Value add strategies could be different. So an example of a value add multifamily we just talked about. But let me give you another example of a value add work, and it's different. Value add work, for example, on a raw piece of land that is zoned for a self-storage construction could be getting entitlements, essentially getting the engineering drawings, approvals from the city to build new self-storage facility. That work of getting the entitlements, getting the engineering ready, can enhance the value of the property, and the property could be sold to a developer at a much higher price. So quite often the land could be bought for $1 million and flipped for $3 million with entitlements and engineering plans. This has happened many times. This is value add, where additional part of value add land could be bought, entitled, and the new self-storage facility constructed. At that point, it will generate income upon completion, upon stabilization. Essentially, the units would be rented. When the property is completely stabilized, it's worth a lot more money. So an example would be that land upon stabilization went from $1 million to $3 million, and then upon completion, maybe another $8 million is invested in construction. All in cost would be $9 million, but the land with the self-storage facility completely operating, stabilized, would be worth $17 million. So all that is value add work. And the value add work creates value regardless of what the market does. The market could go up, the market could go down. But the value add, if executed well, can substantially enhance the value of the property. Another example of investing in real estate, value add work. Imagine it's a distressed property and you're an investor and you're buying a distressed mortgage at a steep discount. And the bank just wants to sell, they don't want to foreclose, they're tired, and you bought it at 60 cents on the dollar and you foreclose on a property. That foreclosing process actually is a value add work. It's different, but it is not building the property. It is not necessarily doing physical labor or doing something else. It's more of a legal process, but it is value add. And value add varies. As I mentioned, construction, obviously, development, redevelopment. You could take an old office building or an old hotel and reposition it to be affordable housing, which has been very popular in the post-COVID era, where these office buildings just people don't want to go back in those office buildings, so that they're dysfunctional, they're poorly occupied, and they need to be sold and redeveloped. We have an affordability crisis in America, and that's one of the strategies many folks have talked about, redeveloping old office buildings into affordable multifamily housing. Similarly, you can redevelop old dysfunctional hotel that has been shut down during COVID, and after reopening is not doing well. So the opportunity is to redevelop it, and the redevelopment of a hotel to multifamily is a faster process than an office to multifamily, but it's still work, and that is a value add. All these examples are value add projects, and investing in real estate quite often involves value add. It's almost like this. You could buy a performing property, completely great shape, fully cash flowing, and that is wonderful. You basically ride that property for many years on its appreciation and its cash flow. The alternative strategy to that is to often buy something that's a diamond in the rough, execute value add strategy, increase the value substantially, and then sell at a good profit. And that's basically how most of the value add projects operate. I hope this was helpful. Appreciate your time and attention. Until the next time. Thank you.